In the last 2 years, BetaKit has reported on massive Canadian tech funding rounds leading to billion-dollar valuations. Here's the Canadian VC who says those numbers are meaningless. Okay, so maybe not meaningless, but in need of more context. Hello and welcome to another episode of the BetaKit podcast. I'm your host, Douglas Saltis, editor-in-chief of BetaKit, and my co-host, as always, is Rob Kennedy. Today on the podcast, we have Damien Steel, managing partner and head of ventures at OMERS Ventures. And why exactly does the head of ventures for one of Canada's largest pension funds hate BetaKit's reporting so much? Well, he doesn't. As he notes on this podcast, BetaKit is his first read for Canadian tech news. But he does take umbrage with how valuations, or more specifically, the sticker price placed on funding rounds, are paraded in the media. To Steel, these numbers belie the true terms of the deal, terms that most reporters and company employees never get to see. So why are they so prevalent? Well, hey man, reporters only have so many data sources we can leverage when triangulating the success of a company. We don't often see the term sheet or the bank statements, and BetaKit takes great pains to dig into all the info we have to provide the most accurate and context-rich reporting possible. It's why we're the only tech publication in Canada that will consistently tell readers if that massive round was mostly in secondary capital or all debt. This stuff really matters. Are we over-indexing on valuations, though, especially in this era of Canadian unicorns? Well, maybe. Perhaps naive journalists are too easily falling prey to the public machinations of entrepreneurs and the VCs who fund them. But while the sticker price of these funding rounds might be as real as the metaverse, the terms of the deal do matter to the founders, their employees, and present and future investors. So what is the value of a valuation? We'll get into all of that on this week's episode, as well as a bunch of important topics as a frothy 2021 transitions into a more frigid 2022. Hint, Damien thinks that winter is coming for early stage microfunds and, air quotes, angel investors using their deals as a, retirement asset class. It's rare to find a VC so passionate about what is best for the ecosystem, their founders, and VCs, but also willing to publicly poop on the current hype train narrative around Canadian tech and tech in general. So let's dig in with Damien Steel. Okay, Damien, we've been talking about having you on the podcast for a while, and I think the initial prompt was I had a question that I had asked you months back, and your answer was so good. I was like, damn it, we should ask him that question again during one of our AMA episodes. But you're way too busy for that. So we've just decided to schedule you into your own episode where we just ask you things that mere podcast mortals would know nothing about and experienced VCs might know a little bit more, and to maybe break down some of the behind the scenes considerations that maybe don't make it too much into media coverage of Canadian tech, startups, innovation, and all that. So we're super excited to have you on. And I think maybe where I want to start is with that initial question that we had been looking to ask you. And I think it relates to what is the value of a valuation when it comes to the company specifically, but then also maybe the VCs investing, but then also maybe how that's portrayed in the media. And I'll set this up for our listeners. That initial question that I asked back in February, God, I can't believe that was 3 months ago. We were checking out a company that had raised $35 million at a $1 billion valuation. That seemed a little weird. And I reached out to Damien and said, does this make sense? Does this not make sense? What the hell's going on in here? And Damien, I think your response was nothing matters, nothing is real. So why don't you break down maybe how you see this stuff, and we can get into the specifics, because we're in the era of Canadian unicorns right now, and billion-dollar valuations, whether they're in US dollars or Canadian dollars, are being thrown all over the place. And you don't seem to be as big as a fan of that as the companies celebrating that stuff or the journalists writing about that stuff.
Yeah. What's funny is when we first talked about this in February, my answer would have been the same. But if you look at what's happened in the last 3 months since then, it's just proven what I would have answered, which is valuations really don't matter. And when I say valuations, what I mean is the sticker price that you put on a funding round. So, I'm company ABC. I raised $10 million at a $90 million valuation. And therefore, I just gave up presumably 10% of my business. And so you might sit there and go, well, that company's worth $90 million. Well, a couple things. First of all, no, the company's not worth $90 million. Just because an investor is willing to give you $10 million for 10% of your business does not mean the company's worth $90 million. To me, if a company's worth $90 million, it means somebody's willing to pay you $90 million for the entire business. And there's a big difference between those two things. But more importantly, and this is where I get bent out of shape sometimes when I see the amount of attention that these headlines receive in the public, is valuation is one part of a financing round and one part of a whole bunch of things that an investor thinks about when they're putting money in your business. So I could show you two different financing rounds that look identical to you in the public's eye. Two companies raise $100 million and both receive $1 billion valuation. And that's all that you would read about in a press release. But in company A, hypothetically, it might be super clean, and maybe they gave up 10% of the business in, standard preferred equity. Company B, however, could be totally different. They may have had to give up 10% of the business in non-standard equity. There might have been a multiple liquidation preference attached to it. There may have been, a cumulative dividend within there.
Okay, you're using a lot of fancy words. You're going to have to break them down for our audience, and not for us, because we totally know what those terms mean.
Oh, those cumulative dividends.
Yeah, but so I'll go back and cover that. But these are all financial engineering on the part of an investor to bridge a gap between what they believe their investment is worth versus what the company believes their company is worth. So let's take the first one, which is the most standard thing, which is liquidation preference. At the valuations that we're talking about at the high level, most of those funding rounds, if not all of them, are done in what's called senior preferred shares. And those preferred shares almost always come with a liquidation preference. And what that means is when you sell the business, that example where I just put $100 million in your business at a $900 million pre-money, so the post-money is $1 billion. Pre-money is what your business is worth before the financing. Then you put $100 million of capital into it. Now you have a $900 million business with $100 million of capital in it. It's worth $1 billion. 900 plus 100 equals $1 billion. And so that investor that put 100 million in would get 10% of the business in standard preferred equity. If you sold the business a week later for $500 million, that investor just takes their money back. So they get what's called a liquidation preference. They have an option. They can either take their money back, or usually they can convert into common shares and take that equivalent of 10%. And that's where that valuation comes in handy. And so in that situation, if you sold the business for $2 billion, what would the investor do? They would take 10%. And so they would take 200 million. But if you sold the business for 200 million, they're going to take 100 million. They're going to take half of it. Knowing that, was the business really worth $1 billion when that investor put their money in, given that downside protection that the investor had? And that is like tip of the iceberg in terms of the bells and whistles that you can find on these financings. Here's one last example. It actually came up in a conversation today. Square, when it IPO'd, if you go back and you look, it IPO'd at some number considerably lower than its last private round. And I remember at the time, there was press releases all over saying, oh, look, it was lower than the last private round. And there was almost this tone that the investors lost in that equation. Well, they didn't. What ended up happening is there was, again, fine print in the deal that they did in that last private round, where they got repriced at the IPO and they got what's called a ratchet, which means they got given extra shares because the IPO was done at a price that was less than what they did their private financing at. And so it's essentially like they went back in time and reset the value that they did their private round at as if it was the value that they just did the IPO at. So they didn't lose a penny.
And that dilutes somebody previously.
And that dilutes everybody else before. That's correct. And that's actually a really interesting point, is this is where the danger lies in doing some of this stuff is, to a company, to a founder, and you got to remember who we're talking about, right? Tech startup founders are a unique, special breed of individual. These are individuals that have an incredible amount of ability to take on risk. They have a level of dedication that is just unmatched. And what usually comes along with that is they are horrible at envisioning failure. I mean, you think about it. You have to be in order to do what they do. And so when you talk to a founder and you start asking them about what their business is worth, a lot of times they fall in the trap of being willing to give some of these bells and whistles that usually, by the way, they usually go away if the investor makes a lot of money. So those liquidation preferences, if you get into what's called multiple liquidation preferences, which all that means is not only do I get my money back, maybe I get a little bit more. So like a guaranteed return. But what I'll tell you as a founder is, hey, I need this guaranteed return, but don't worry. If I make 3 times my money, it all goes away. And it will be as if it was just super, super simple. And so when you're a founder, and a founder who doesn't want to envision downside, that seems like a really attractive proposition. It's like, oh, you're going to give me my $1 billion valuation. I know I'm going to grow into 3 billion one day, so I don't care what I give you. And then things don't go as you think they should go. And, inevitably business is hard and, competition comes along and markets shift and a whole bunch of stuff that is just really, really hard to predict happens. And all of a sudden things don't go as you planned. And now you're stuck with this unique feature on your capital structure. And here's the kicker, is if you take on money with any of these kind of funky structures, I can almost guarantee you that every single round you take after that point will also have those structures.
It pushes the funk downstream, basically.
Yeah. And so what I try and tell young entrepreneurs that, I mentor over the years is all of these things, all of these bells and whistles that investors attach to their deals, all they are financial engineering to bridge a gap between what the founder thinks the business was worth and what the investor thinks the business is worth. And what I encourage everyone to do is, instead of being willing to accept those bells and whistles, have the hard conversation up front and just settle on a value that makes sense. And realize that valuation that you ascribe to your business, if you're ultimately wildly successful, it's not going to matter, because you're going to probably, in our world, again, remember, we're talking about venture-backed tech startups. So very, very important, because that's a unique type of company. But most of these companies are going to be raising multiple rounds of financing. No matter how much you try and maximize valuation in the early days, I've seen great companies where, founders give too much equity away. And then ultimately, at some point, the investors realize, look, you need to be aligned with us. And they end up filling them in the back end anyways. And so it's arguably a very simplistic view I'm giving, but my point is still accurate, which is have the hard conversation up front, do the hard work up front. Don't fall in the trap of only maximizing for valuation. Instead, find the right investor, the investor that you think is going to help you grow your business, and then figure out a clean structure that makes sense.
Let's dig into this kind of the more you know moment here, because you're talking about one circumstance where maybe the founder is optimizing for upside potentially, or maybe the sticker label of the valuation, but there are a couple other motivations here. And we come to this, and the reason why we've had this conversation, I think a couple times really, there's the VC motivation for why this might happen. There's the founder startup motivation for why this might happen. And then there's the media interest in this that can amplify both of those things, but then also impact employees at the company. And I'm wondering if you're seeing now, and part of the reason why we've been talking about this so much more, is a greater emphasis right now on hitting certain valuation milestones in what was up until maybe say the beginning of the year, a very frothy, accelerating market, or if there are other circumstances driving that. Because it was revealing to us for you to say, the valuation is never a true or singular indication of where the company is going. You said even specifically, it's not included in the press release, all of these other scenarios. For publications like BetaKit reporting on these companies, we have only a certain number of signal markers to go on because we never see the terms of the deal. We never actually technically verify the cash is in the bank. And that doesn't mean that we're not diligent. In BetaKit's reporting, there have been a number of instances where we've caught companies maybe saying one thing in the press release, another thing in reality of the company. But we only have so many external touch points. And I think one of the touch points that we've looked at is whether the numbers are like historically aligned from previous rounds going forward, as if the dollar increments in the deal terms are going up in a way that seems regular or stable. Now, a couple things that have been happening since, say, 2015, when I took over BetaKit. Everyone now is raising a multitude of convertible notes at the same time, and they're not trying to price anything, making fuzzy numbers everywhere. And then it seems like deal stages by seed, Series A, B are completely non-existent because we have companies saying that they're raising their like A2 round now. Like there's no orthodoxy to the process to have kind of a standardized evaluation for us to say, hey, there's some variance here. This looks a little weird. Maybe weird good, maybe weird bad, maybe just weird interesting. We need to dig into this. It seems like everyone is taking whatever interesting deal terms or valuation numbers, like the motivations per company seem to be exploding in variance. So I'm wondering if you, from your perspective, are noticing new motivations for this stuff beyond the simple classic founder only believing in upside, being willing to bet on, going from 1 billion to 3 billion and not really worrying about it. That's a very standard founder flaw across a variety of scenarios. That doesn't seem to be a situation where you have companies saying that they're worth $1 billion after their first raise. There's more going on here. Or companies that refuse to raise an A round, but they'll raise 5 seed rounds. What's motivating that right now?
A couple of things before we get into the motivation, because you touched on a whole bunch there. One is, you're absolutely right. The name of a round means absolutely nothing. Whether you call something a seed round or an A round or a B round, it's just an order, nothing more. The details underneath matter, not the name of it. And another thing you kind of keyed in on, which let's just call it what it is. This is what companies do today, right? And this would drive guys like you and other people who are trying to report on this stuff. It must drive you crazy. But what companies do is they say, well, I want to maximize the publicity around that dollars I raise. And so I'm not going to announce things that don't look like my ABC traditional type of financing round. And then when I finally do raise my financing round, I'm going to loop it all in together. And so it looks like I raised a whole bunch more money. Why do companies do that? Why are we so obsessed with announcing that we've raised as much capital as possible at as high valuation as possible?
Are you going to blame tech media on this tech podcast right now, Damien? Is this where we're going?
No, I've made too many friends in tech media over the years to throw you all under the bus. But nor am I going to throw founders under the bus because they're who I love to work with. But here's the reality: is there's quite a bit of vanity built in, not just the founder, right? Well, VCs fall right into that bucket as well. It feels really good when you're a fund and one of your portfolio companies puts out a big announcement saying that they raised a whackload of capital at a really high valuation. And you can go back in time and see that, hey, I'll pick on myself. Hey, look, OMERS Ventures. Wow, remember that Hopper round when they invested and it was valued at 500 million? And now it's 5 billion. Well, they must be really smart, right? Like we all chase that kind of that endorphin hit. Everybody falls into that trap. So that's a real thing. But what companies also think about, and this is where I would argue there's varying degrees of reality to this, is they think about the war for talent. So over this time period that we've been talking about, it also happens to be the hardest time to hire people ever that I've experienced in 15 years in venture. I'm referring to the last 2 to 3 years. And so there's this idea out there that, hey, we need to look like a hot startup. We need to look like a rocket ship to attract the best talent that's available in our market. Now, that's a double-edged sword because the reality is if you want to hire senior people, like the people who actually understand how this stuff works, they know I want to come into your company when the share price is really low so that I can benefit from it. Because when you give me options, they're going to be priced at some number. Here's another little dirty secret, is usually options are priced at about 30 to 50% of the price of the last private round. So if you're an employee joining a startup, you should ask two questions when given options. One, what is the strike price on those options? And two, how many total shares are in the business? Because if you give me 1 million options of a company that has 1 billion shares, that's not as good as 1 million options in a company that has 30 million shares. That makes sense? So ask those two things, strike price and total capital in the business. And the strike price, what that is the price I have to pay in order to exercise my option and essentially buy shares. And so, Douglas, if you raised a round for BetaKit and I joined as an employee and you gave me options and those options were priced at $1 and you gave me 10,000 options, well, I have an option to buy 10,000 shares at $1. And so presumably if we can, grow the business and sell it for a price where it's $10 a share, I just made $9 a share. So I buy every share for $1 and I sell them for 10 almost immediately. So the employees know that they should be optimizing for, I want to get in as low as possible, then ride the wave. And so the double-edged sword comes into this point of, if you're a company, on one hand, you may think, hey, I need to show growth to attract the right people. But on the other hand, you need to realize that the smart people realize that as soon as you announced that deal that valued you at $1 billion, that strike price on those options are at least 30 to 50% of that price. So in this example, that means that those options are priced at a valuation of probably somewhere between $300 and $500 million. That's a big number. So if I'm a CFO and I want to join a rocket ship, I want to join before they announce that $1 billion financing. Because the minute they announce it, that firm that you hire to do the valuation of your options, that is one of the leading indicators they use in order to go through their valuation work and price those
dumb nerd question. If you're in on those early shares, the one thing I've always wondered is, could you not be diluted as an employee? They would issue a whole bunch of shares at a subsequent round. So whatever the answer to the question is, was cool the day you asked it, but in a year or two, there might be another round and your million shares out of 30 million, to use your example, becomes $1 billion and you're like, you have no control over that. Does that not?
Yeah, that's not a dumb question. It's absolutely correct. Yeah. And that's so if you're an existing employee now, you need to realize that, hey, this is great that the company I'm working for is able to raise all this capital at these high valuations, but every single time they do it, you're getting diluted. So that second question that you asked when you took those options of how many shares are there in the business, that number just went up.
Specifically, every time there's like a financing event, there's an opportunity to rewrite the rules of all that's come before it, right? Not necessarily so, but we see this with acquisitions, acqui-hires, companies going public, that terms of the deals for past investors or shareholders as employees don't necessarily carry the whole way through. And I think, you had mentioned before, yes, I will say to our audience right now as a tech journalist, it drives us fucking crazy when we're talking to these companies.
We're allowed to swear on this? You should have told 100%. Me that way earlier.
Sorry, I should have told you. Yeah. You're being so reserved and polite, and it's amazing. So I'm just going to open this up. It drives us batshit crazy when we are talking to companies that we know are like, no. It was always our plan to raise 3 $1.5 million convertible notes over the last 18 months to figure out what our product is, because the pre-A is the new place that because they're completely afraid of putting a signaling label on their company and their round or their deal that would hurt them down the road. We understand that, and then we work very diligently to hold them accountable to their statements and the evidence that are provided, even with the limited amount of information we have. The new thing to do is to just collect, never announce funding until it's a big enough number. And then you announce funding and it happens to be the funding you've raised over the last 2 years where half of that money or more has been spent. And then BetaKit does a lot of work to track companies that say they're raising like a $25 million round. And it's actually like, well, 12 of that was from 2 years ago, or this much is in debt. And we do a lot of work to parse that because we believe in reality mattering. Where you're bringing this to is then the impact of individuals reading that story. And I'm not so worried about the experienced CFO. I'm not worried about the senior international talent that Canadian companies are trying to attract. That's in the next segment where we're going to talk to. Where this seems to be most damaging is for the general employees who are maybe post-COVID looking for a career change, want to join tech companies, feel that like, oh, I need equity in this startup. I got to get on the rocket ship, and not understanding the terms of the scenario that they're getting into, and either undercutting their total compensation package because they're overvaluing something that's never going to convert into value for them, or joining companies that have structured and leveraged themselves to the point where that promise is never going to come true. And I don't think we need to talk about Shopify too much on this podcast. Like, I don't think OMERS owns any Shopify anymore, so I don't think it's too big of a deal. But I know that there's an ongoing conversation right there for a company that is publicly traded trying to refinagle the levers between employee options and compensation at a time in which their valuation or their shareholder value has dropped like 60%. This is an always on consideration. This doesn't end. But particularly for, let's say, junior employees, new employees to this who haven't been through this process before, there can be a real buyer's remorse in joining a vision when the terms of the deal, which you might not 100% be privy to, don't hold to that vision.
So one small correction here, and just in terms of the way we describe this, is I think it's very rare for financing rounds to result in previous kind of share structures being changed. What actually happens is different structures get layered on top of you, which changes your outcome.
Okay, but if the top of the waterfall decides that no water goes down to the people who are at the bottom of the waterfall, like what it didn't overwrite that, it just prevented that from happening. And I know, you had mentioned Hopper, I won't mention like other, when we talk to other VCs who might have appeared on this podcast who are earlier stage in investments than say OMERS is, they talk about, betting on winners, betting on founders, and then beating off other institutional investors with a stick to hold their position in the company because they know unless they prove their value or their worth through a couple of stages, they're not going to get the return that they're looking for, that they can be exited from the game. So I agree with you, but I think we're all learning a lot here about all the different ways that deals can be arranged to create similar outcomes. Would you agree that the general outcome is the same, is that new deals can change the course and the understanding of prior deals, whether it's overwriting them or just preceding them?
I think it changes your outcome as a shareholder, as an early shareholder, which an employee technically is, right? When you get options, you're an early shareholder. Here's what I would say. I'm not giving employment advice to anyone, but here's what I would say if a friend came to me and said, hey, I'm going to leave my cushy consulting job and I'm going to go into startup world. And I've had lots of friends who've done this over the years. What I tell them is really simple, is look, your compensation package is going to be made up of two main elements. You're going to get a cash compensation, and then you're going to get an equity component. And the reality is the way those two things are very tied to one another. As your cash compensation goes down, your equity component goes up and vice versa. And so usually, you can flex that in some way, but here's the kicker is it will come across way better to the company that's about to hire you if you want more equity versus cash comp, because it shows that you believe in the business. But I think it would be an enormous mistake for a mid to early employee to put too much stock into that stock, if that makes sense. I don't think you should rely on the value of your equity in a startup. I think that's it's just too hard. I mean, think about what I do for a living. We bet on 10 companies that are highly, highly, highly vetted, knowing that 5 of them are going to go to zero. Zero. That means nobody gets anything. If you're a 25-year-old engineer looking to join a tech company, I would go in and simplify it and say, I'm optimizing for a vision that I believe in, a founder that inspires me, and I want to make sure that my cash comp pays my bills, and the rest is gravy and upside.
You should have said I'm optimizing for Toronto rent and home ownership prices, but We can
That's
talk about that in a
impossible.
different segment.
Yeah.
Okay.
Yeah.
So
But one last comment on this. Here's where the market that we've been in starts to play a role in all this. We've just gone through the longest bull market in history, and especially in tech world, right? So most people, unless you're old and getting gray like me, have never experienced anything other than up and to the right. In the last 5 years, you have more companies that have been funded, larger funding rounds than ever before, and less companies have gone out of business than ever before. And that has created this false sense of math, right? Like at the end of the day, for me, when you're looking at thousands of companies, it's simple math, unfortunately. No offense to anyone, but this is tried and true. You can argue that, tech is evolving to allow more companies to succeed, which I would buy into that argument. But still, at the end of the day, we're in an extremely risky asset class. And a lot of these businesses are going to go out of business. The ability to measure that risk of the business failing has been lost on a lot of people. Investors have forgotten how to price it. Employees have forgotten how to think about it. Right across the board.
I don't think most of the employees or investors have even experienced. I think that age bracket across the board. I think there's a lot of people who are investors now who started in tech probably in 2013 and never experienced like 2008. Hey, the Beta Kit podcast is brought to you this week by Osler, the leading business law firm for startups, high-growth companies, and investors in Canada. Hey, including even Beta Kit. The firm has just released its Deal Points report on venture capital financings, an inaugural study of 332 anonymized Canadian venture capital and growth equity financings. Now, the report looks at deals from 2019 to 2021 and provides data and insights for founders, entrepreneurs, investors, and advisors contemplating transactions. So if you want to read the new report, you can check out the Deal Points report on venture capital financings at osler.com. That's OSLER.com. Beta Kit, for the first time since COVID first hit, since the first 5 months of 2020, we're starting to write about company layoffs again. Company layoffs for companies that have raised hundreds of millions of dollars within a quarter, right? So the tightening is starting to happen. And there's been a lot of talk. I don't know if you are a regular reader of the Globe and Mail. I have to, otherwise Sean Silkoff calls me in the morning.
I start with Beta Kit.
Thank you.
Then I move on to the ROP.
Use that in every promotional material we do for this podcast. But there has been a lot of conversations about what is happening in the public markets, the bloodshedding of tech stocks, how that's going to impose upon private valuations of tech companies. We've been seeing other macro considerations that we can get into, like what's been going on with Tiger Global. We just wrote something about teachers kind of doubling down at a time in which other funds, pension-based funds, are looking to diversify back out. There was one thing, maybe if we can talk about the market downturn impacting valuations and what that means, not in terms of the magic numbers that are used for recruitment or whatever, but in terms of like fundraising, I'd be really interested in that. And then you had noted something that you wanted to talk specifically about angel investing and what happens there. So can you just give us your prediction for how you're seeing it, or timelines, or how you're talking to companies that maybe raised a year ago or raised 3 months ago or raised 18 months ago, how those different stages are approaching heading into 2022, looking to secure additional financing?
One, I'm not going to predict, but let's talk facts. Everybody was a genius in 2021. Full stop. If you're a founder of a tech company, you were able to raise, and you're smart, you were able to raise more money than ever before, and good on you. You should have, and I hope you did. If you're a VC, you all think you're geniuses, and us included. Let's be real honest with ourselves here. As investors, whether you're angel investors, seed investors, Series A to C like OMERS, you are all sitting on an enormous amount of markups across your portfolio. And it makes you feel really confident and really good. Well, what the public markets are showing us today very quickly is, the way these things trickle down is public markets are very fluid, right? These are real-time measures of valuations and what investors are ascribing as multiples on businesses. Today, so what are we? We're 3 months into a material market correction. The NASDAQ is down 22% off of its high, which is actually not as high as I thought it was. I looked this up today before this call. I would have expected it to be closer to 30. And the reason for that is when you look underneath, there's actually a bunch of high growth stocks that are down 50 to 80%. And then there's some big ones that are obviously keeping it afloat. So there's been a material market correction on the publics. I can tell you real time what we're experiencing in the market. Later stage companies. And so these are ones that I would say $1 billion plus valuations, $100 million plus financing rounds. You've started to see in the last month to 2 months some of these bells and whistles that I referred to at the start of our talk. Multiple liquidation preferences, maybe 1.5 times preference. So, hey, not only do I get my 100 back, but I get 150 back if you don't succeed. We haven't yet seen that a lot in the what I call early stage venture. That is Series A to Series C. You're seeing less funding rounds get completed. So, VCs, we're human beings. In times of uncertainty, what do? We freeze. Well, think about what happened when COVID hit. We all froze for 3 months. And then we all realized, oh my God, I got to get back to work. And we all deployed way more money than we've ever done before in history. So right now, I'd say we're in that healthy freeze position where everybody's a little more cautious, doing a little bit more diligence. And this term has been thrown around a lot by in the Twitterverse and other blogs or podcasts I listen to. There's a real flight to quality. And what that means is when you're an investor and you're feeling really good, like in 2021, you fall in the trap of investing in a wider range of companies than you otherwise should. And similarly, in the reverse happens, which is when markets correct, you end up narrowing your focus arguably too much, and you start really focusing in on what you're comfortable with. And so there's this kind of quality doesn't necessarily mean the quality of the business, but it means quality in the eye of the investor, which usually is just that core vertical that they're really comfortable with.
Alignment to comfort.
Yeah, exactly. And so that I think is what's happening now. But over time, what you'll see is that impact that's being felt in the public markets will start to trickle down into the earlier rounds. And the last to be impacted are going to be the angel rounds, the seed rounds. Those are still getting done at a healthy clip today because these investors are still living in 2021. And so this was my point that I just wanted to make to the angel community, which has exploded over the last 3 years, which again, one view of that is this is great for the tech community, like more angel investors, more companies get started.
What the ecosystem has been waiting for to complete the flywheel, right? All of those Shopify, Lightspeed.
Yeah, I will take a somewhat controversial view and say that I actually think that pendulum has swung too far. Meaning there are people angel investing today that shouldn't be angel investing. It wasn't too long ago where you talk to really smart angel investors and they would tell you, look, I do this because I love to back founders. I'm passionate about supporting founders who are starting businesses. Nowhere in that equation was I want to make money. That was a byproduct of backing amazing founders. I speak to angel investors today who literally say it's their business. These are people who were an operator and they started making some angel investments. They all got written up over the last couple of years. And now they're sitting on these overinflated portfolio values of unrealized investments. And there's a false sense of security. Not only that, not only have they been written up, but over the last couple of years, there's been secondary opportunities for those investors. So the time to liquidity has been majorly compressed, which has allowed that market to fuel itself, which is, again, a good thing in itself.
Secondary is just for our audience being when the capital does not go to the company itself, but to potential owners.
So in those late rounds where there's a little piece of that late round allows angel investors or management or early investors to take some money off the table, which if you're an angel investor or early investor and you get the opportunity to do that, you should always take a little bit off the table.
That's a poker.
Yeah, it's a poker thing, but I don't take credit for that. I read a blog by Fred Wilson once, and it was one of the best pieces of advice as an investor I think I've ever read, is when you have a chance at liquidity, You take some chips off the table, no matter how great you think the investment is. And I would say you should do that in the early stage. So, but my point here is you have a large group of investors who've grown up in a world that I don't think is normal. I think the last 3 years was unique in a whole bunch of ways. And my worry when looking at the ecosystem is that we don't adjust, right? The professional investors are adjusting already. That's their business. It's all the others that need to realize, hey, my time to liquidity just got elongated 3x to where I thought I was going to start getting money back. So you got to think about that when you're starting to put these $5, $10, $25,000 checks into these startups. Now all of a sudden you're not getting, it used to be, don't expect liquidity for 10 plus years. And then the second thing is we're going back to a world where that ratio of failure to success will go back to normal.
It's not 5 out of the 10 companies going to zero. It's 15 out of the 20 going to zero.
So I'm not saying like, hey, we should all be alarmed or worried or any of that. I just think we need to be cautious and understand the market that we play in. Again, I say we as in the venture-backed tech community, which is very small sliver, is a very, very risky asset class. And I expect it to go back to feeling that way.
I don't know when it was exactly when the Series A crunch happened, but do we end up in this weird situation where you've got so many angels throwing money into these companies that maybe weren't as viable as they could have been because they had to jump through a few more hurdles? And then you have all of these people car accident crashing into the, Series Seed. I don't know what we call it these days.
It's all pre-A. It's just all pre-A.
Right,
now.
but there was a version of, it almost felt like every letter got pushed one, And now it feels like if there's a lot of companies who are easily getting this seed money, and then all of a sudden these investors, the angel types, start either heeding your advice, Damien, or just start getting spooked. And the professional investors, we're not creating them at the same rate as we're creating the initial smaller checks. Are we looking at a car accident? I'm not asking you to prognosticate necessarily, but does this match a pattern of the past when these kinds of downturns happen? I'm old enough that I always ran for the .com bust as well, which was a bigger kind of sense of a bigger amount of fuckery in my world because it was a more unknown what the fuck is happening than 2008 for me, at least. Is that a thing or is that not a thing?
Look, I think there's going to be some whiplash here? Absolutely.
Sure.
And the way I think it'll translate in our market is, look, here's the good news, is more funds have been created than ever before in Canada. More dollars have flowed into funds from outside of Canada, which is a great thing too. And these first-time funds, some of them just won't survive. They're going to raise second funds off the backs of the great write-ups that they achieved in their first fund. But then fund 3, they will be measured on realizations. The investor world there's 2 things that investors talk about, and this is some lingo here, is TVPI, which stands for total value to paid in capital. So what that means is, hey, I run a $100 million fund and my portfolio is worth $300 million worth on paper. My TVPI is 3 times. And then the more important acronym is DPI, distributions to paid in capital. What that means is how much money have you returned? I don't care what you think your portfolio is valued at. Prove it to me. Like, show me that you can actually generate realizations and give me back my money as an institutional investor. And so that measurement of quality or that come to Jesus for the market, that's coming in the next couple of years. My hope is that most of these first-time funds can get through that, because I genuinely view this industry as, I call it co-opetition. Like, we all benefit from these funds succeeding. Like, I don't look at any venture fund in Canada as a competitor. I cheer for Inovia, partly because they're a great partner, but 2, because they're trailblazing and they're putting Canada on the map and they're making us all look better.
And you're all in each other's deals anyways, right?
And we all share, we're all like, but the collective we, the ecosystem, we need these first-time funds to be successful. And that's where I think you're going to see a little bit of carnage, which is, not everybody's going to survive. And that's, again, it's simple math,
It's true. It sort of almost further proves my point, which is that the early stage money kind of gets a little messier, and then you run into a car accident of founders who maybe they shouldn't have got the valuations that they got.
Yeah. Just one last comment on that, because I don't want people to think I'm picking on early stage. The same thing is going to happen at late stage, right? Like there are a lot of late stage investors that are in difficult positions now because they've overextended, and so we're all in it together. And I think we just need to really focus in on like quality and making sure that, when I said, hey, 5 go out of business, 5 succeed, I'm obviously being overly simplistic in my math. We need the 5 that succeed to do really, really well. And if that happens in a business that's driven by outliers, the whole ecosystem wins and it resets. And that's how you build a venture ecosystem.
So in the answer you just gave, you mentioned it'll take a couple of spins of the cycle, say for earlier stage funds, to actually then start looking at whether they actually are returning stuff. And it almost connects back to where we started these conversations about valuations. At the end of the day, I feel like, correct me if I'm wrong, but the reason why people report on that stuff and the reason why people are interested in it is it truly is, it's completely opaque until the market really values it, right? So if it's a 10-year cycle before you IPO or get acquired or whatever, you've got 10 years to scratch your head and say, I think it's worth this. And I understand that VCs are professionals at saying, well, this looks like this and this person's French and therefore pi equals this, right? Like you've got some fancy formulas. And I mean, we've had on this podcast, maybe previous iterations of this podcast, we've talked about studies. I think U of T had a study that looked like at number of valuations of unicorns as a metric for the health of success for the Canadian innovation ecosystem. And we've had the conversation where like, is that even a thing? Like, does that even tell you anything? Because it seems kind of like bullshit until they actually are successful. They aren't.
It's not a thing, but if you got to pick something, right? Like this is where I sympathize. Yeah, you have to pick some metric, and I wish we would. I mean, Douglas knows this. I just wish we'd stop using the word unicorn. Like it's
yes,
it's done with. Like let's move on.
Now and you'll see this this will have already gone live after the time we've recorded, but now there's like the distinction between like a unicorn and a Canadian unicorn.
Yeah,
right.
Yeah,
because they like, hey, we reached $1 billion valuation in Canadian dollars, right? And we don't need the U.S. terms anymore. We can. It's omnipresent.
Look, I think the whole point of all this discussion, I think that the one thing to take away, it's not hating on companies announcing financing rounds, because let's remember the VCs are to blame as well, right? That's what we didn't talk about is like VCs have to raise money themselves, just like the companies do. And so they have all this, similar, like different but similar stresses. Like we want the institutional LP community to read the news and think, oh, wow, there's a lot of good stuff happening there, just like the companies do. But it's not about hating on that whole thing. The message I hope people take away is the devil's in the details. And so you can get a pulse of a market on this type of stuff, but don't ever pretend to be able to evaluate an individual company based on what you read in a headline. Impossible. You just don't know enough. And so whether you're an employee that's looking to join a company, whether you're an investor that's looking to fund a company, any player in the ecosystem, you need to be careful and you need to like do your diligence and get into the detail and figure out what the right questions to ask are. And that valuation, that what I call sticker price, is one of many, many, many things. And I would argue it's one that's far down on the list of importance.
Yeah, you read the headline and you click the link and then you read the rest of the story. Okay, so that's an important takeaway and one that we're really willing and open to have as a conversation because we're so engaged with it in our day-to-day reporting, because we're trying to provide the most in-depth and context-filled, if not analysis, identification of what's happening in the space. And we only have so many. I would love if companies gave us their books. I would love if they showed us the cap table, their terms of the deal. I think our reporting would be greatly improved upon seeing that, but it's not going to happen. So we have to use what signals we have, and how much we weight them is something that we're constantly thinking of. But I want to go back to some of the other implications, because you were just talking about, so there's some early stage VC funds, there's the $10 million and the $20 million funds that are being raised right now, not really from a lot of institutional money, but like almost a super collective of other high net worth individuals who are giving one person who's exited a Canadian unicorn or IPO'd company the opportunity to go through. We're seeing this all over the place, covering it almost weekly on BetaKit. What's the impact of the companies who have bought into kind of this influx of early angel investment? Like, are they just screwed? You were talking about these early stage funds having a really tough time with Fund 3. What about the companies that those funds invested in as this reality hits? Are they going to be able to, are they just caught in an endless cycle of, let me rephrase this. Generally, when you see early stage companies struggling to get product market fit, you'll see them have a bridge round and extension round from their primary investor because they believe in them enough to carry it forward until they get things right sized to scale. Or they're like, we're just going to protect our investment regardless because it's if we don't give it money right now, it's going to die, and we want to give it a little bit more of a chance. When we're talking about these like angel collectives, these almost sole sourced, smaller 5 to 10 million funds, they don't have the ability to like stick with a company a little bit longer to do that. Like are companies that are taking money from these kind of firms that are going to have difficulty screwed because they're going to have to start all over again looking for an institutional investor to believe in them again.
I wouldn't say they're screwed. I would say, nothing has, there's more of these early stage funds, but their ability or their limit at which they can continue to follow on has not changed over time. What's changed is the amount of money that early stage companies are willing to spend early on. In an environment where capital has been in an abundance and it's available at every turn, I would argue that companies have early stage companies. Now, these are the ones that are even earlier than OMERS Ventures would look at. I would argue that some of them have fallen in the trap of increasing burn too fast, right? You go back 5 years ago, it was very common for a founder to raise a seed round and hell or high water, they were going to prove product market fit before they needed another dollar.
Because that was the terms of the deal for an A round. Is that that was the product market fit?
I love telling this story because I over the years when Hopper used to get all this press attention, I would have these arguments or debates with reporters who will not be named, and I would say you're missing the real story here. We put $10 million into Hopper in 2012, and Fred hadn't spent a penny of it 2 years later. That's the story. You had a founder here who knew exactly what he was doing. He was no dummy. He knew that, hey, I just raised a bunch of money, but my God, I got a lot to figure out before I run out of this money. I think that mentality has it hasn't completely gone away because there's a lot of, second-time founders out there who've lived through this. But to a first-time founder who hasn't lived through that kind of environment, it's just different, right? And so my advice, for whatever it's worth, to a founder is, look, if you're lucky enough to raise some venture money at whatever the amount, $1 million, $2 million, last year it was $5 million, you always need to be working backwards. You have to realize that you live and die by the ability to raise your next round. And you should never fall in the trap, especially in the early stage, of assuming that round will be there. And the first question you should be asking yourself the day after you raise money, you celebrate one night, go out and get drunk, get over your hangover the next day. And then your first meeting should be, okay, paint me a picture of what do we have to look like in order to guarantee we can raise our next round. Gather your leadership team around the table, all agree on what that picture is. It can change, you can adapt, but paint a picture and then work backwards and say, okay, how do we get there? And you literally, if you just raised $1 million, you draw a line between $1 million and zero. And these are all the things we need to do before we get to zero. And the reason you build that model isn't to make a VC happy or your finance team happy, but it's so that you have your finger on the pulse. And every month you go back to that model and you say, okay, where are we tracking? Are we still tracking on that line? And if you drop below that line, meaning you won't get there before you run out of money, you adapt. You either raise more money if you can, you cut burn, you raise debt, you get really scrappy. And all the things that we used to do 5 years ago that today is just like this wave of capital, and like inefficiencies have like kind of built themselves into the ecosystem. We got to go back to just really rugged, kind of grind it out and really conserve cash until you know that you've had those proof points.
You sound like Jack from Lost right now. And it's and for like an old guy podcast, you're matching the vibe very well. But even I think for us, this is tough because again, we're dealing with an environment and I'm not sure if this is something where you're just talking about the old way of doing things that aren't there right now due to the influx of capital all over the place, but then also the massive amounts of U.S. capital that are coming into Canada or if this is a Canadian way of doing things that doesn't exist anymore, because every company now has a preponderance of US capital that they can have access to, but they also have the pressure of, like, they're supposed to spend that money in 18 months to go do a thing, or they're supposed to do it sooner. And you're seeing companies raise multiple rounds at the same time or within like a 6-month time frame. So I think we could do a full thing debating on what the genesis of that was, why it went away, and that. But I just want to note that while Damien sounds like the dude from Lost, they did eventually go back to the island. But I want to maybe close this off. We're digging into a level that I think both founders who listen to this podcast and employees who listen to this podcast really need to hear, as they're like staring down the barrel of what's going to be. It's just going to be a correction year. We're already seeing it. We're already aware of other stuff we haven't reported yet. It's just going to happen for some companies. I want to talk a little bit more, and you referenced it previously, about talent, because, and this question is coming from our associate editor, Megan Simpson, because when we were kind of pulling together, because we wanted to have you on that AMA and talk about why you think BetaKit's headlines suck and focus too much on valuations and unicorns. One of the things that we hear when we talk to a bunch of VCs at all stages, they're concerned a little bit about, one, competition for deals, but then two, some of these companies that like had raised in 2020 right before the pandemic, and now all of a sudden they're coming into an environment where they've got a lot of explaining to do. When you talk to the founders of those companies, however, Megan's telling me that they're kind of concerned about raising again, but there seems to be so much, maybe they're just short-term focused and they see so much money just flying around that they assume it's going to be there for them. They're way, way, way more concerned about talent. So from your perspective, from the OMERS perspective, what is going on in this talent circumstances driven by remote work, hybrid? How is the downturn, how is the correction going to be impacting that? Because we're seeing Canada's largest tech companies struggle to compete salary-wise, or having to change its maybe some of its internal values to compete salary-wise. You've advocated very strongly here, if people didn't hear it, for employees at startups to not be compensated on a promise, but be compensated on a salary that allows them to earn a living wage in Toronto, Vancouver, Montreal, or whatever farm you live on, being a remote engineer. What's the impact that you're tracking when you're talking to your portfolio companies about how concerned they are about talent? Because it's really changed. It used to be we couldn't get US talent to come to Canada. No one cared. And now it's, oh my God, all these US companies can suck up Canadian talent because the Canadian talent doesn't need to move anymore, and all these US companies can pay more. That was a concern in the boom year of 2021. What's the concern founded upon now?
So yeah, again, start with just an acknowledgement of where we are and where we've been. Is the war for talent has been raging for the last couple of years. It's never been harder to hire quality people. And why is that? Because more companies have been funded than ever before, and less companies have gone out of business than ever before. Like the normal flow, ebb and flow, there's a cycle to this stuff, right? And it'll change over time, but every year you have a certain amount of companies that get created. Every year you have a certain amount of companies that go out of business, and that talent gets recycled, and it's like a whole beautiful ecosystem. Well, that normal flow of the ecosystem got really messed up over the last couple of years, because the time at which these companies live got extended. And some of them are going to benefit from that and go on and create amazing companies, and other ones are just going to still ultimately fail. And that's totally fine. So we estimate that like the cost for engineering talent in Canada increased 40% last year. And I've seen this data. It varies by market to market across Canada, but it's a pretty good peg on like what happened to comp. And so cost went up. The ability to get people went down, which further drove cost up. But something interesting is happening right now, and that is larger companies are starting to read the market, and some companies are starting to proactively adjust their spend. Again, back to that equation, a late stage company does the same thing as I described an early stage company should be doing, which is ask yourself, how long does your cash last? What do I need to look like by the time I run out of cash? Whether you're a $1 billion company or a $10 million company, it's the same equation. It's just a bigger model. And those late stage companies are doing that math and they're going, whoa, good on us. We raised a bunch of money last year, but now the market will no longer price us anywhere close to what we raised money at. We don't want to raise money at a down round. That just feels wrong. It has a whole bunch of negative connotations to it. And so what are we going to do? We're going to make our money last longer. What is the single largest cost of any tech company? It's people.
Certainly not office space.
Yeah, no. So we're starting to see companies proactively adjust their burn and they're starting to downsize. And so for the first time in a long, long time, you're seeing arguably very successful companies downsizing the size of their talent pools. And the market is going to benefit from that a little bit. So I guess where I'm getting at is my little crystal ball. I don't know when it's going to happen. I actually expect this challenge we've had at attracting talent. I expect that to get better, not worse, due to a whole bunch of these things that are happening. It's bad news for companies that are having to lay off people because these are human beings and it's never easy to go through that process. But the good news is for the ecosystem is you've got some really quality people that are now available to hire. And so I think that pressure is going to be alleviated somewhat over the course of the next 12 to 24 months.
Even like, are the US companies hiring into Canada going to be making that same consideration? Because from their standpoint, aren't they saying like, well, we would never lay off our Canadian employees because
cheaper and have healthcare.
Yeah, well, yeah, totally. But then we can also pay them like less than the average of anyone working in the US. And for them, it's a huge boon. Like I see that within the Canadian ecosystem, but how much is the fear being driven by external forces? Like there's an external investment forces coming into Canada, which has been a huge boon, but there's also external talent grab.
Look, I see Meta coming into town. I see Amazon coming into town. I see them hiring people, but I also see the Canadian talent pool growing alongside it. So I'm actually less concerned. And here's something that's maybe unpopular, but the best startups that I work with don't want to hire from those companies. It's a different type of culture. It's a different type of employee. And so again, you need to like step back and like realize what segment of the market am I in? What type of people am I really looking for? And I would take the overly simplistic view that, you know, some of the stuff that you're mentioning, yeah, it's noise and it definitely has an impact. I don't think it has as big of an impact as some people might put out there.
So maybe the place to close then is, you know, we had Anthony from RBCX on a few episodes ago talking about how Canadian VCs generally they lean pretty heavily on the Canadian government in one way or another to help them out. I mean, assuming you maybe accept the premise, maybe you don't. Do you think that the change in the weather will help, will cause the community to lean in further into expecting stuff, especially because it's election years all around? Or is that just you don't buy the premise?
Anthony's my buddy, so I can poke fun at him.
Okay.
Very, very easy for him to say from RBC. Look, listen, I think as an ecosystem, that is an old line that I've heard for 15 years in this business is, oh, Canadian VCs are backed by the government and there's too much government money, whatever. Like the more government money, the better. We need to support these funds. We need more support for these funds. And it gives them room to prove that they're good at what they do. Here's what's happened though in the last couple of years. Yeah, but I know Canadian funds who've in the last couple of years have raised money from MIT. They've raised money from Blackstone. They've raised money from some of the US pension plans. That never used to happen 5 years ago. You know, that is one of the best news stories for our ecosystem, you know, than anything else we've talked about, because it's the fuel that allows this thing to keep growing. And so, yes, we're still supported by our great government. That is an asset. We should not like look down on that. There's some arguments out there that creates, are the right people getting the money? And people, you know, are always up in arms around how that money gets distributed. Listen, admittedly, I'm in a somewhat privileged position when I say this because I have OMERS that supports our venture fund, and it's an incredible position. But listen, I've been in this business long enough. I started my career in venture fundraising unsuccessfully, by the way, 15 years ago. So I know what the pain is like. And it's getting better. Just look around. Look at some of the funds that exist today. They're not all backed by government. Like that's just false. Yes, some of them got started or got part of their fund was through some of these programs, whether it's VCAP or others. I just look at that and I say, those are all good. We should celebrate them. We can always do better in terms of how that money gets allocated, but that's details. Like overall, I think our ecosystem benefits from that. And the few examples I gave you, like there is real proof of outside capital coming into this country because it's no longer a secret that there's some great Canadian companies in our ecosystem. I've had 3 calls in the last 2 weeks with US investors, and these are, this is part of my job. I meet US investors all the time. This is what we do at OMERS. You tell us what you do, horse trade, all that good stuff. And all 3 said, hey, I'm spending more time in Canada this year because we've identified it as an interesting ecosystem of great tech opportunities. That's amazing. And so not only do we have money coming into the Canadian funds, the border's gone. We have US funds coming in to support our companies. And again, you might think that I would view that as a bad thing because it's more competition. I don't. I think there's enough great companies to go around. And again, back to the point I made earlier, we either win as an ecosystem or we lose as an ecosystem. And so to that comment, I say, bring it on. Like more the better.
Well, thanks for coming on the show. I think what we'll do next time is we'll have you and Anthony grudge match. That'll be in a few weeks. Stay tuned.
Tony Dagger versus Damien Steel.
Yeah, it's going to be a grudge match.
Sounds like a 60s spy novel. The Beta Kid Podcast is produced by Beta Kid Incorporated. It's edited by Katie Lohr, and its hosts are Rob Kennedy and me, Douglas Saltis. To learn more about how you can support this podcast, head to patreon.com/BetaKit.